Stress tests are a fundamental tool for risk management to assess the stability of financial firms and systems under stress, both during and after a financial crisis. In this podcast, we discuss the design of stress test scenarios, risk identification, and loss estimation with Til Schuermann, partner at Oliver Wyman and co-head of risk and public policy practice for the Americas. This conversation was recorded at the European University Institute in Florence on the 10th of April 2019, in the occasion of a course on stress testing organized by the Florence School of Banking and Finance. Dr. Schuermann, thank you very much for being with us today here in Florence for this course on stress testing. Stress testing are a fundamental tool for risk management to assess the stability of financial firms and systems under stress, both during and after the financial crisis. So how does one design a good stress test scenario?
Well, thank you. Thank you very much for having me. It's been a tremendous couple of days, a few days actually, being here in this amazing institution, actually. Stress testing has really changed quite radically how banks think about risk management, but perhaps even more importantly, how supervisors and the official authorities have thought about and approached capital adequacy, solvency, determination, assessment, and also risk management. One of the key components for this, as you mentioned, is the design of the scenario, right? It sort of all starts with a scenario that you contemplate the banks to go through. It's a state of the world that you imagine the banks to live through and hopefully survive. You can think of it as a little bit as you have a sailboat and the sailboat needs to ride through a storm. How severe is the storm? And then correspondingly, you also need to decide how good of a shape does the sailboat need to be afterwards. So it's a combination of both the severity of the scenario and how safe the bank, how much capital the bank needs to have at the end. The key to designing a good scenario is really to think about two things that are complementary. The first is, what are the likely risks and the important risks that face the economy, and not just the economy of the country that you worry about, especially for smaller countries that are very dependent on exports and have banks that are very active in other countries, the economic and financial market well-being also in other places. The second is, what are the vulnerabilities currently facing the banks in the banking system? Because you can think of an infinite number of scenarios, but really the only ones that are interesting are the ones that are going to probe the vulnerabilities of the bank. So those two combinations together, what are sort of broad vulnerabilities of the economy and the financial markets? And then what is especially of interest and important of when you want to probe the vulnerabilities of the banks?
Picking up on your point, the vulnerabilities, of course, identifying the vulnerabilities as well the risks in the market are crucial to understand how a bank may perform in those different scenarios. How can a risk identification approach be truly effective then?
So I think risk identification is among the most basic elements of risk management. I can't manage if I don't know what it is. I can't manage a risk if I haven't identified it. And I certainly also can't manage if I haven't assessed whether it's big or small. So I need to first identify the risks. I'm especially interested in the risks that arise under stressful conditions. There are risks all the time, but the ones that I think are especially valuable to understand are the ones that arise when the world sort of becomes a much more dangerous, much more unstable place. Here, a couple of things. So first, the very design of the scenario and the impact that it has are themselves part of the risk identification process, right? So if I ask myself the question, well, for example, for my commercial real estate portfolio, I lend to developers to develop office buildings, to build hospitals, to build stores, infrastructure projects like airports. What makes those projects vulnerable? What are the risks that come to those projects? And immediately I have to think of, well, what might happen to the world that would make these projects unprofitable or generate losses? Therefore, a really good risk identification process is one that immediately thinks about and contemplates the states of the world that would result in and make the risk of this particular project, this particular loan, for the company, for the household, for the asset class. If you're thinking about auto lending, for example, what would make that riskier and what would make exposure to those asset classes or those kinds of projects especially vulnerable?
Moving on to a separate topic, but still linked to stress testing, loss estimation is, of course, a core component of stress testing. So could you please explain how this kind of estimation is performed and what can we learn from its application to the activities of financial institutions?
So you could think of this as the Zen of stress testing. It is not so much the destination, but the journey that matters. In developing the translation, the mapping, essentially, from the state of the world to the outcomes in the bank, so that could be profitability, loan impairment losses. It could be losses in the trading portfolio, the default of large counterparties. I have to think very carefully in some detail about what are the fundamental risk drivers that are behind auto loan losses or profitability in small and medium enterprise lending or vulnerabilities in my trading business, especially, say, in my options business. So if I want to generate those losses, predict that profitability, I need to have a pretty good understanding, and in fact a very good understanding of which are the major risk drivers. And you can broadly think about those in two categories. One is in the macro risk drivers that we describe in the form of a scenario. So it could be unemployment, it could be GDP, it could be stock market index, or interest rates, either risk-free interest rates or credit spreads. So those are the way that we describe the world in the form of a stress scenario. And then there are more micro risk factors that probably are also impacted by the state of the world. So it could be a consumer credit score, for example, that are going to impact the outcome. Then there are other things that you need to control for. So, for instance, geography often matters. Not all regions of a country or not all countries will suffer equally. There will be other risk factors like I talked earlier about commercial real estate. For some states of the world, hotels are going to be more impacted than department stores. Office buildings in downtown areas will be affected differently from office buildings in outskirts. So these risk factors I need to understand, I need to control for, and it gives a very nuanced, or should give a very nuanced understanding of what the risk sensitivities really are in the book. And these are not just for losses. These are also for income, understanding the income, the profitability, whether it's interest income or all the various sources of non-interest income from fees to commissions and so on.
These are factors that indeed practitioners in the financial sector must keep in mind all the time while performing stress testing. And in particular, in this course, you conducted a simulation of stress testing. And if you had to select one key takeaway from this course as well as from this exercise as a suggestion that you want to give to a person performing this activity, which could be either one of the participants that we had today in this course or one of our listeners, what would that key takeaway be?
At the risk of sounding like a broken record, I think the combination or the pairing of risk identification and scenario design and then impact on stresses are kind of a trio that are mutually reinforcing. And that's true so far we've talked more about at an individual bank level. Also, at a supervisory level, you're interested in understanding the vulnerabilities of the whole banking system. Usually the way that stress tests are run, you just have one scenario. Well, one scenario, and if you have 10 banks, it may be stressful for 1 or 2 or 3 banks, but it won't be equally stressful for all banks. So which scenario do you pick? It's hard enough to do it at one bank level. It's going to be even more difficult to do it at a country level. So having a careful understanding of what are the risks and vulnerabilities inside a bank, think about that in terms of this scenario. Recognize that it's an iterative process. You often don't know whether if the scenario you picked is in fact stressful until you run the stress test and you realize, well, maybe I didn't pick the right scenario because over here, for this bank, the losses are large, but for these other 2 banks, the losses are actually very small because they have a different business model, because they have different risk exposures. So recognizing the sort of iterative process that is part of stress testing, that by doing more stress testing, you learn more about the risks. By learning more about the risks, you might change your exposure, you might change even your planning and your strategy, which then will influence the scenarios that you design in the next period and so on. It should become a very integral part both of how the banks do risk management and planning and how the supervisors in turn assess the vulnerability of the banks that they supervise.
And that's a very good suggestion. So thank you very much for your time.
Thank you.
Thank you for having listened to this podcast by the Florence School of Banking and Finance. For more information and to listen to all our podcasts, visit the webpage fbf.ui.eu/podcasts.